Welcome back to Yahoo Finance Live this morning, everyone. Major averages, they are seeing a boost after October's CPI data indicates that inflation may be finally easing up. Taking a look at the futures right now, the Dow Jones Industrial Average up 800 points, 2.5% there. You've got the S&P 500 up 3.4%. And the NASDAQ futures, my goodness, up by about 4.5% right now. Also, if we can check on yields just very briefly, this is one of the biggest drops that we've seen in yields since September 28th, so 6 weeks ago. You've got the 5-year moving lower this morning by about 5.9%. We'll round that off to 10-year also lower by about 5.6% at this point in time. And then you've got to look at the 30-year yield down more than 3%. Let's take a deeper dive into the numbers and how it might affect Fed policy and the broader economy. Joining us now with more, we've got Michael Gapen, who is the Bank of America Chief U.S. Economist. You see this reading come across your desk, come across the terminal. What immediately goes through your mind? And does this signal any type of Fed pivot to come in the near term, or at least a pause?
Yeah, the first thing that came across my mind was finally some relief on goods prices. I think we and many others have been saying, goods prices are still 15, 16, 17% on average above 2020 levels. They haven't started to come back down yet. Supply chains have eased at least a little bit. Inventories have rebounded. Household spending's rotating to services. Man, when are we going to see some relief? And we've been getting that now. Apparel has been down 3 of the last 4 months. Used car prices down 2.4% today. Likely further weakness in those going forward. So I think good news really in this report is around the good side of the equation. And yes, I do think it means the Fed can slow the pace of its rate hikes. We're looking for a 50 basis point hike in December. My caution here would be just to say, when you peel back the good news on this report, services inflation is still quite firm. Shelter running 0.8 on the month. So there's good news here, but obviously we have a long way to go in terms of taming inflation.
Michael, are prices coming down because we are already in a mild recession?
No, I don't think so. I mean, we do think we'll have one sometime in calendar year 2023. We're thinking more the first half of the year. Others are thinking the second half. So there is an expectation for some softening in the economy. But right now, I would say no. I think what this report tells us is that it's reasonable to think that prices of some durables items like used cars, which were 50 to 60% above February 2020 levels, that we can have declines in those categories. So to me, this is more about still kind of unwinding the long tail effects of the pandemic, and that core goods prices can come down even if the U.S. economy stays fairly healthy. So I would say services are more about any potential downturn in the U.S. And that's why I think we in the forecasting community are all still kind of thinking, well, if we don't get the labor market imbalances corrected, services inflation could be sticky.
It's really sticky in housing right now, though. I mean, for the average consumer, anybody who's paying rents, where can they finally expect some of that to ease or abate?
That's a very good point that you make. Housing inflation has been quite robust. And even if you broaden the lens a little bit and look at the cost of housing, purchasing and financing a home, right, it's a big chunk right now of household expenditures. Given what the BLS is measuring and how it samples housing in the CPI inflation, you are looking at lags where what's happening on the ground today probably doesn't get reflected for, say, 6 months. We do think that in the first quarter, February, March, April, we should see some of that shelter and housing related inflation start to slow. Again, just slowing the rate of increase, not looking for declines in this case, like we expect for some core goods categories. So I would say kind of keep an eye towards the first quarter of the year. What was important today is getting more information about the good side of the inflation picture. First half of next year, we think we'll start to get more clarity on the services side and housing in particular.
So, Michael, you think this market rally we're seeing here in the pre-market is justified? I mean, we theoretically could see a Fed in the first part of next year say we're done raising rates.
So I think that part of it is correct. I wouldn't look at this report and think, well, the Fed's getting close to easing policy. But I think if you were worried at least that inflation and strong labor markets may push the Fed to get rates to 5.5%, 6%. Maybe this takes the edge off of that. I would just say I still think the terminal rate's more about the labor market than it is about where inflation is at the moment. So I think this report should provide confidence that the Fed can slow the pace of hikes. We still think the funds rate will get 5.25, and by March of next year. So yes, maybe this says if you were thinking the Fed's going to tighten through the middle of the year, maybe this pulls that back. But again, the Fed's not going to be thinking about victory until inflation is solidly on a path down to 2. And therefore, I would say it's reasonable to think they stop tightening in the first quarter, but cuts maybe at the earliest, very late 2023, which we have in our forecast, or early 2024.
Bank of America Chief U.S. Economist Michael Gapen, always good to see you. We'll talk to you soon.
Thank you.